I'm going to talk about clearing today, and when we first came into the industry, clearing was, I guarantee you, not sexy at all. Most people didn't really know what clearing was or how it worked. It was just a back office sort of process. So let me start with just a little bit about OCC. OCC is the world's largest equity derivatives clearing organization. Last year we cleared roughly 4 billion equity derivative contracts, primarily individual equity options and then cash index options and other products, and I'll talk about that in a second. In many respects we function sort of like a large bank or a credit card company in a sense, in that we are the guarantor of obligations between buyers and sellers, and I'll talk more about that in a minute. But it's a pretty large scale operation in terms of what we do. We hold on any given day roughly $100 billion in collateral, and we move several billion dollars back and forth between market participants each day. But primarily what we are is a risk management, risk mitigation mechanism to ensure that people have confidence when they're trading, even in the listed markets, and that they're going to see the performance of their contractual obligations through the clearinghouse mechanism. And then we're a transaction processing company, obviously, in the sense that, as you can imagine, if we're processing 4 billion contracts a year, that's a big part of what we do. So who we serve? We serve our clearing member firms. We have more than 100 clearing member firms who act as credit intermediaries on behalf of public customers and also on behalf of themselves in terms of their trading activity, and that ranges from asset managers and hedge funds, large corporate enterprises, pension funds, insurance companies, and also certainly retail investors trading through those clearing member firms on 12 options exchanges and 4 different futures exchanges, all of which clear their trades through the Options Clearing Corporation. And then, as I'll talk more about in a moment, we also serve, in some sense, our regulators, because like CME and other large exchange clearinghouse organizations, we're a systemically important organization, and so we look at our regulators as stakeholders in what we do as well. This is just sort of recent history in terms of the growth of some of our products. This shows the growth from 1997 to 2013, just in terms of the number of issues on which we trade options, and you can see there's been tremendous growth. I mentioned, the bulk of what we do is in individual equity options, cash index options, and a variety of other more complex option products, but also, as well, we do offer clearing services in a range of futures products and other instruments as well. It's been a great growth industry. Thankfully, like all of the derivative markets, we've had a tremendous track record of growth over 40 years. Between 1997 and 2013, our compounded annual growth rate was almost 17%. And so you can see that, in options and even in futures and non-equity products, the growth has been just tremendous. So 2008 was obviously a pivotal year for many people in the industry, and there were many problems that caused the economic crisis. But in the derivatives area, one of the problems that was easily identified was just the lack of central counterparty clearing type mechanisms in the OTC market. We had, a situation where the world's largest banks had tremendous OTC derivatives exposures opposite each other. Many of those contracts were ones that, they didn't necessarily margin, or they didn't necessarily value their exposures frequently or objectively. And so in a market where, you really depend on trust in terms of bilateral credit exposure between major bank institutions, the market froze up. And one of the solutions that the regulators came to at the G20 level, and then ultimately here in the United States in terms of Dodd-Frank and then the ensuing regulations, was to try to shift more over-the-counter derivatives transactions toward central counterparties. And that has really resulted in a huge sea change in the way that central counterparties are viewed and understood and regulated. And people have much higher expectations today for the resiliency of central counterparties than perhaps they did in the past, even though they were always viewed as very, very important. So for those of you who may not be that familiar with central counterparties versus what typically existed in the past and still continues to exist in the over-the-counter markets, one of the things that makes us unique is we have, this kind of daily mark-to-market and this sort of pay-as-you-go system where, after you've deposited initial margin, as the value of your positions fluctuates each day, you have to make what we call settlement variation payments to the clearinghouse through your clearing member firm, each and every day, sometimes twice a day. That's in distinct contrast to the OTC markets where bilateral credit exposures on swaps might not be revalued, quarterly, sometimes annually, and generally very infrequently. The second part that is very different is that because of the nature of the role that we provide and the fact that we are the guarantor of all transactions in the entire listed options market, we're very conservative in our approach about margin collateral. It has to be very high quality. It has to be highly liquid, easily monetizable, and that's also very different. Oftentimes in OTC markets, collateral wouldn't even be exchanged, or if it would be, it might not be highly liquid, or it might be valued subjectively in a way that doesn't assure that when you go to liquidate it, you can get the money and you can come up with the cash. And so the other part of our system that makes us very different is that the clearinghouse is capitalized by the clearing member firms, and we have very stringent membership and financial requirements for our clearing member firms. And we also provide significant audit and supervision oversight of them. And then secondly, we have what we call a guarantee fund. So the guarantee fund, which in our case is in excess of $4 billion, is really there to ensure that if the first line of defense, which is margin collateral, were to fail, which it shouldn't, but if a clearing member firm were to default, then the guarantee fund is there to help ensure that we can meet the obligations of the defaulting clearing member firm so that it doesn't affect other clearing firms and the functioning of the clearinghouse or the guarantee that we provide to the customer. And then beyond that, we have assessment powers as well. So this is very common architecture for most central counterparty clearinghouses, and it's one of the reasons why people view it as a sort of resilient credit mechanism in markets. So I mentioned Dodd-Frank, and one of the things that Dodd-Frank did was it created the Financial Stability Oversight Council, and it gave them the power to sort of, in an overarching way, across all the different regulators like the CFTC, the SEC, the banking regulators, to make determinations about what are systemic enterprises in the financial markets today. And as you know, many large banking institutions have been designated, as well as other institutional investors, as systemically important. And in July of 2012, OCC and seven other major exchanges, clearinghouses were designated as systemically important. You might ask yourself, what makes you systemic versus not systemic? Essentially, it's that your failure or disruption has the potential to create significant liquidity or credit problems among financial institutions, or to threaten the stability of the U.S. financial system. So in OCC's case, because we're the only clearinghouse that clears individual equity options and the other products that I mentioned, we are the underpinning for the entire U.S. options market, and by extension, the U.S. equity capital markets. So obviously, we fit in the definition of systemically important. So what does that designation really mean for us? It meant significantly expanded oversight because we clear both equity and options products and futures products. We're regulated directly by both the SEC and the CFTC. But as a result of this designation and the FSOC We also now we have an additional level of oversight from the Board of Governors of the Federal Reserve Bank as well. That introduces another layer of complexity, one of which is that the SEC is a very kind of prescriptive rules-based regulator. The Fed is really much more of a principles-based regulatory framework, and that means that oftentimes there's more subjectivity in how they regulate. And so in times when the imposition of much more stringent regulation is imposed on us, we have to figure out how do we comply, and we have different ways in which we comply with both the expectations of the SEC and then the Fed. Another thing that happened for systemically important institutions is that before we even make rule filings to change the way in which we manage risk and the way in which we operate, we actually have to give the regulators advance notice. And we do that to our direct supervisory authority, which would be the SEC in this case. And then they have to consult with the Fed. So we have a much longer timeline for every aspect of our business, including innovation. So if we have new products that exchanges that clear through OCC would like to bring to market and they have to clear them, this adds more time and more complexity to the innovation process. And then the other thing is that everybody's very focused, including the banks, on central counterparties and making sure that they really understand them. And for lack of a better way of describing it, 20 years ago, most people took for granted that central counterparties were resilient, they were well capitalized, they functioned well, people generally understood how they operated. Today, because of the importance of these institutions, because they're systemic, and because the banks have to really be worried about who their counterparties are, there's a call for much more transparency from clearinghouses in terms of every methodology that we use for margining and stress testing and other things. The other thing is, like most major banks, we're required to have a living will also, and so we're required to develop recovery and wind down plans that essentially lay out the way in which we would deal with a systemic event that affects not only our clearing member participants, but potentially the clearinghouse as well. So a lot of the new challenges that we have are, we're really expected to further enhance our own resiliency. So what are examples of that? In the past, clearinghouses would generally say that they would like to have sufficient resources on hand to always be able to overcome the default of their single largest clearing member firm. Today, most large clearinghouses are operating on what we call a cover 2 basis, which is that they have to have enough resources to be able to recover from the simultaneous failure of their 2 largest participants. And so that may mean, for example, that the guarantee fund may double. It may go from several billion to 7 or 8 billion. And that obviously creates tremendous capital pressure on clearing member participants. The other thing that is hitting us as a clearinghouse is that there's much more emphasis on checks and balances, governance frameworks, and what we call the control functions. So we have a 3 lines of defense model where the first line business units are expected to have very rigorous, heavily documented policies and procedures, model documentation, model stress testing. And then we are expected to have a second line of defense, which is the enterprise risk management function, the model validation function, which are ways of categorizing and assessing risks, making sure that we have risk mitigation efforts in place to deal with those risks. We have a risk reporting framework that exists at the management level, at the risk committee of the board level, and then at the full board level as well. And then we have the compliance role, and the compliance role is really there to ensure that we have rigorous design testing and operational effectiveness of all of our control systems. And then the last line of defense is the internal audit function, which is coming in always throughout the year, doing regular audit programs to determine are all the policies and procedures and controls being effectively followed? Are they in place? Are they working? Are there gaps or deficiencies and whatnot? And then layered on top of that, of course, are all the regulatory reviews that we undergo each year as a so-called fourth line of defense. So it's a really different environment that we're operating in, much more capital intensive. So those are a lot of the changes that are affecting us. Central counterparty clearing, I should just say in the conclusion, is it's a really important part of how these markets function. If the clearinghouses don't work and if people are not assured that their contracts will be performed, you can imagine they might be much more tentative about trading even in the listed markets. So with that, I want to thank you for inviting me to be here today and turn it over to the next speaker.